Welcome to the Thematic Investors Podcast, presented in partnership with Vidrio Financial. Vidrio Financial is proud to support the Thematic Investors Podcast with host Kieran Cavanna. Unlock the potential of precise and dependable investment data with Vidrio Financial's data management solution. We shoulder the responsibility of your data, from its collection to extraction, transformation, and enrichment. With a track record of monitoring over 2,000 diverse funds and processing millions of data points each month, Vidrio leads the discussion on how investors can harness advanced AI and human expertise to maximize alpha performance and enhance their data accuracy. Discover how Vidrio empowers your data with comprehensive analytics on performance, cash flow, risk, and valuation, all delivered seamlessly through Vidrio's Data Management Hub. By consolidating multiple systems into a single source of truth, Vidrio saves your investment teams valuable operational time, providing actionable insights like never before. Explore more at vidrio.com.
Welcome to the Thematic Investors Podcast. I'm your host, Kieran Cavanna, CIO of Old Farm Partners. Our goal is to bring you great investors and the themes they're working on. Some are under the radar, and we think they're all experts in their disciplines. I'm excited today to talk to Arvind Sanger, who runs the hedge fund Geosphere. Welcome, Arvind.
Thank you, Kieran. Glad to be here.
Great to see you, Arvind. We've known each other for a long time. Arvind runs a hedge fund focused on natural resources. Geosphere has a long history, but before that, he worked at SAC Capital, which is now Point72. He operates his firm in Miami and New York. And in my mind, Arvind is an expert investor investing in these cyclical equities. So I think, Arvind, to kick off, would you mind giving a little bit of a rundown of your background? Just a bit how you got to the seat that you're in today.
Sure. Well, I was a sell-side energy analyst for 15 years and followed the oil and gas related sectors and shipping a little bit for that time. And when I made the switch to SAC in 2002, I went in to run an energy book. But very quickly, as I got more involved in energy and understood the breadth of the energy opportunities, including in coal, and then subsequently in nuclear, but also in other parts of the growth story for energy that was being driven by China's and emerging markets boom that was driving that cycle in the early 2000s through 2007, 8, and even after the financial crisis for a couple of years. That became a natural resources portfolio, and shipping was always an important subcomponent of that. And that's more or less what we are doing today. With as we go through our different cycles, there are always add-ons which are not completely step outs but related. So that's where we are today in terms of what we do today, which is essentially natural resources related industrials and shipping. And that's something that I've been doing now, on the buy side for over 2 decades.
You've certainly managed big books before, and I know how big a book you used to manage at SAC and then on your own when you started Geosphere. But you mind going through the strategy a little bit more? Because I think that you've always been a bottom-up investor, and you're always deep on the details, but top-down is such a big influence. And I've seen you long and short the same names over a cycle. So maybe you could go down your strategy a bit more.
Sure. Look, at the end of the day, I've always run a long short book. I've not been a long only, but I've never been a market neutral investor either. When I was at SAC, actually, the leeway was a lot more than people realized back before 2008. If they gave you $1 billion book, they said you could be 30% net long, which would be 300 million on a $1 billion book, which if you divide by 2 to say equity was 500 million, you could go up to 60% net long. You just had to watch your drawdowns. But there was more leeway. When I ran the fund at Geosphere Part 1, it was during a tough time, especially after the 2008-9 8 crash and 9 modest recovery. And 2010s were terrible period for energy and metals and mining. So we ran a much tighter net during that period. So that was kind of as I would call it, horses for courses. And when we started this new fund that we now call Sensible Energy Transition, which is less than 3.5 years old when we started in fourth quarter of 21. This is meant to be run more longer net, which is not too dissimilar from what I ran at SAC during that boom run that we had in the in the early to mid 2000s. And so that's kind of where we are from a gross and net exposure. We do find opportunities on the short side because no cycle ever goes in a straight line. And secondly, within the subsectors that we invest in, not everything performs as well as everything else. So you can have a bull market in coal, and you can have a bear market in maybe oil, or natural gas versus oil, or uranium versus something else, or or copper may be really hot. So these are things that we watch for, but most of the time we're not making big directional bets in terms of finding good companies. If we say oil prices are going to stay in a $70, $75 range, then we're trying to find good companies that are going to make money. We're not a CTA that is making big directional bets. But the reason the macro is important is it informs A, the amount of risk that you put on overall, and B, where your exposure can also be in high beta names, low beta names, depending on the macro environment and how supportive it is. So the macro does inform some of our positioning, but it's not the be all and end all of what our major alpha drivers are. But it is very important, certainly to survive in the decade of the 2010s. Having a macro overlay to be able to manage risk was absolutely essential.
Well, we'll get to 1.0, but I think 2.0, you named your fund the SET fund, which is the Sensible Energy Transition Fund. And, I would love to hear a bit more about, is there a lot of non-sensible or energy transition? Because I think what's unique about what you're doing, I meet a lot of people doing energy transition, and they have a bit of a mission on ESG or something new energy, alternative energy sources. You do both, and I think you're just profit seeking, right? Maybe you could go through that just a little bit on Geosphere 2.0.
Well, when we started Geosphere 2.0, we first called it the Brown Tech Fund. And that caused some consternation because people were not sure what we meant, because it was meant to be not green tech, because that was, if you remember in 2021, everybody was so caught up on ESG, on green. There were other things, biotech and others that were popular, but energy, conventional energy was very unpopular. So we wanted to make a statement, but I think where it got confusing is people didn't understand whether we were being anti-ESG. That wasn't the goal. So by putting sensible energy transition as kind of the name that we chose, very quickly switched to that, it shows that we're looking at the energy transition as real. We're not denying the existence of energy transition, but we think the nonsense, if you will, which was the original thesis of the fund, and that still remains, is the idea, it's the opposite of, there's a saying, if you build it, they will come. The assumption was if you don't invest in it, they will stop using it. If you don't build it, they won't come. And that we thought was nonsense. The idea that if we stop investing in fossil fuels, fossil fuel demand will go away was a complete fantasy. And that's what underlay our investment thesis. And that is what continues to drive our approach to investing. We are agnostic about, but I will say one thing. I had an analyst focused on, and we invested in solar and wind companies in 2008, 9, 10. Most of those companies went bankrupt, went into trouble, whether it was Chinese or it was European or it was US. I got cured of that desire to invest in wind and solar back then, and I haven't made the bet on wind and solar again, but I'm open to nuclear, I'm open to carbon sequestration, to companies that might sell equipment into whether it's ammonia or hydrogen or whatever may come up as potential new energy sources or energy kind of alternative ways to express that. And even for wind and solar, I'm happy to own companies that provide copper and steel and other materials needed. We're just looking for where there is real demonstrable, like you said, profit-making, money-making opportunity. And if it's in coal, so be it. And that's been one of our biggest winners in the last 3.5 years of our fund, If it's in nuclear, uranium, anything related to that, that's great also. And so we're open to wherever the opportunity leads us.
Without violating any sort of constraints around marketing or anything, I could say that you've done really well against the long only market, and I think that's a great segue into what you're seeing out there right now, because there's so much going on. I think it's the biggest focus right now is U.S. power. I think there's a data centers angle to it, of course, but also there's a U.S. onshoring angle. There's huge policy changes underway. I'd love to know what you're seeing right now and what you think is most important.
Well, that's a very interesting further to our thesis. Our original thesis was based on the fact that the rich world was going to be more energy cautious, and it was lecturing the poor world about energy switching to green, whereas the demand for fossil fuels was going to be driven almost entirely by growth in emerging markets like India, Southeast Asia, parts of Africa, Middle East. That was the original thesis. What has really changed that thesis and made it turbocharged is the rich world suddenly deciding that AI and data centers are more important than green. And nobody will admit that. And the tech companies will try to greenwash themselves as much as possible by going and signing deals for nuclear and whatever. But the reality is most of those nuclear deals are pushing out some other customer and signing a deal to pay a premium, which means the other poor customers who got kicked off the nuclear power source have to go to fossil fuels. So yes, I think the demand for energy, if you look at the power demand in the US and in the developed world for the 2 or 3 decades prior to 2018, 2019, it grew at probably 1% a year, if that. And suddenly the power demand in the developed countries is now growing at 3.5% a year, which may not seem a lot, but the implication of that demand growth going from 0 to 1 to 2.5 to 3 is dramatic in terms of the amount of energy needed. And we've looked at reports which talk about the fact, there are some optimists on the ESG side which talk about the fact that 75% of this demand through the end of this decade, between now and 2030, will be met by 75-80% will be met by green sources. And I think that that's fantasy. I think,
Right.
If you're in Asia, which is a smaller part, but it's growing very rapidly, it's growing fastest, but from a much smaller base, it's going to be primarily coal. If it's the US, where because we are such a energy-rich continent and energy-rich country and natural gas-rich country, it's going to be natural gas. And the reality is that, yes, wind and solar will be important growers, but from a much smaller base, and they still will not provide base load. And as for nuclear, other than the restart of some shutdown plants like the 3 Mile Island and a few Japanese plants that are restarting, you're not going to see incremental new nuclear capacity of any magnitude, even a very small magnitude, SMRs, small modular reactors, until 2030 or maybe later. And it'll take a few years to meaningfully make a dent. In the meantime, the demand for energy is insatiable in terms of AI data centers. And there's one other important element, which we in the US don't realize. Countries in the Middle East, India, China has been doing it for a while, are insisting that data centers carrying their citizens' data, credit card companies, others carrying their citizens' data that is put in some offshore location where it was the cheapest. No, they want it on-sourced. So the biggest driver for data center demand in India today is onshoring of data from offshore before even the AI picks up. So there's conventional data center demand is growing at 9% a year, according to one of the estimates we've seen. And the AI data center demand is growing at 25-30% a year. So there's both elements of it, but the data demand is going to be, data center is going to be very powerful.
And add in a little electrification, right, for basically our fleet. I mean, just there's so many things that you can talk about that are, but it seems like the real catalyst has been data centers in the U.S. And I think when you're talking about nuclear, no new nuclear, that was in the U.S., right? Because China's pretty rapidly building a nuclear fleet. Do you think that this is obviously I'm leading the witness, but I think because there's so much, it's very uneven though, right? What you're talking about, this growth is not. I know PJM, like the biggest grid in the United States, is just to hook up something sizable will be half a decade, just because there's so much demand. And in other parts of the world, there's a lot of excess capacity. Is that one of the reasons you're not long only? Because I mean, what you're saying sounds long, like it sounds like a very obvious long strategy, but you're long short. And from what I remember, you're finding a lot of interesting shorts.
Well, look, 2 years back, we were short natural gas producers. We were short North American oil service companies because gas prices had gotten to $9. We didn't see any demand drivers that could justify that, and there was a hope that European prices were much higher, so they would benefit. But the reality is that if there's no LNG export capacity, that wouldn't benefit. If I were to say I've gotten bullish on natural gas in the last 3 months, it's nothing to do with data centers right now. It's 3, 4, 5 months back. What has happened is that you have these new LNG export capacity coming on. Today, gas prices in Europe are $16. Gas prices in the US are around just under $4. As this LNG export capacity comes on, there will be some incremental demand that'll drive that. Now, the data center demand has multiple legs to it, and that'll come on over time. But in the meantime, 2 years back, we were long international and offshore focused oil service companies while we were short North American oil service companies and natural gas. The North American oil service companies and the natural gas producers came down a lot while the offshore and international boomed. We have completely turned around that today because what is going on right now is, and oil prices are still fine, whether they're 70, 75, 80 is not the driver, wasn't the driver 2 years ago, is not the driver today. What has happened is that a lot of the offshore drilling boom that began, there was you have to go back in history. The bust started in 2013 because prior costs were too high. The 2014 oil price collapse, offshore deep water drilling costs were too high. They came down. It started recovering in 2019, 2020, just started because they had brought the cost down, got it rationalized, and then COVID hit, and it started again in 22. But what's happened is that now you have a lot of these projects that need to be hooked up to production. So they're waiting on FPSOs, they're waiting on other things. In the meantime, the new drilling has slowed down. So you have a hiatus here for a year that has created this headwind where some of these offshore-oriented companies have gone down 40, 50% from their highs in the last 12 months. So the point that I want to your leading question is that at the end of the day, I'm very bullish on offshore drilling because nobody is going to build a new rig, which is a 20, 25-year asset, which will take 3 to 4 years to build, which will cost $1 billion to build, because they're going to need some fantastically high rates, and they're going to need some confidence that those rates are going to last for 10, 15, 20 years, which almost, in my opinion, makes it very unlikely that we will see any sizable new build. So that's a real great long-term bull story. But I'm not going to be blind to the fact that even within that long-term bull story, there's money to be made on the long and the short side. And that's the same thing as I said in gas. So yes, these are great, big macro themes, but the magnitude of the corrections up and down, particularly on the downside with a modest correction, can be such that having a short ability to short and seeing that opportunity in front of you is I think it'd be silly to pass those up.
Makes a ton of sense to me. I would love to go down coal a little bit. That's the third rail for a lot of investors, and you're Indian yourself, and you think globally, and I know Americans really don't think about coal too much. Only shutdowns, but 2024 I think was, if correct me, but I think it was the biggest coal burning year ever, and 2025 is going to be the next one. And so, could you just give a state of coal for a minute?
Well, I think I may not have the exact year, but since 2018, I believe coal has been supposed to be peaking in the next 2 years. That assessment continues even today, that it's supposed to peak in the next couple of years. So let me tell you, there are two major uses of coal. One is for thermal purposes, for power generation, and the second is for steel making. Now, steel making is the one that I find the most interesting because I think the story for coal demand for steel making has got a decade of demand growth. And let me explain. There are two ways we make steel. We make it either in a blast furnace using metallurgical high BTU coal along with iron ore, or we make it in an electric arc furnace, which uses cheap electricity and uses scrap steel and a little bit of iron ore pellets. Now, in the West, in the US particularly, but also in Europe, we have switched a lot from blast furnaces to electric arc furnaces because it's much more energy efficient. But the reality is that you need a lot of scrap steel, which means you're a large installed base. Today, the second largest steel market in the world is India. And the fastest growing steel market in the world is India. And they're adding 10 to 15 million tons of new steel capacity. They don't have much scrap steel because they're still an emerging market with a growing small installed base and growing infrastructure. So what are they doing? They're building everything, almost everything with blast furnaces, which requires met coal. In the same time, the world has decided that the coal is a 4-letter word, but steel is a 5-letter word. Nobody's saying don't use steel for building wind turbines, for building hydrogen plants, for building nuclear power plants, or for building infrastructure. At the same time, they want to pretend, and the biggest pretense, in my opinion, is hydrogen. Hydrogen is one of those frauds that's being perpetrated on the world because the reality is, where do you get cheap hydrogen? You get cheap hydrogen next to where you have cheap surplus renewable. Where's the cheap surplus renewable in the US? It's in West Texas for wind. It's in Nevada, California desert for solar. It's offshore Europe for the wind turbines, which produce cheap wind power. Where are the steel plants? The steel plants are located where there is iron ore or met coal availability. Ruhr Valley in Germany, Ohio, Philadelphia, Pittsburgh, that area, or other parts of the U.S. where you had conventionally the natural resources needed. You can't transport the hydrogen because if you mix more than 8% hydrogen in a natural gas pipeline, if you use an existing pipeline, the hydrogen leaks because it's number one on the periodic table. The molecules are so small, the existing iron-based pipelines can't hold it. So you're going to have to build new steel plants there. The long-winded way of coming back to your coal answer, met coal is going to be needed for a long time. That was our thesis all along, and we think it's going to last for a long time. We were thinking also that thermal coal demand would peak any year now. We were in that camp. Mm-hmm. But with this data center boom coming, I was just talking to a US coal company, where we've reduced our coal consumption by a huge amount by half, I think, in the last decade and a half. And this US coal company is telling me that their customers are telling them that the plants that they were planning to shut down between now and 2028 are not going to be shut down because they can't afford to shut anything down, given the increased baseload demand needs coming from AI and data centers. That's so, if you're building new data centers in the US and in India and China and whatever, that's going to have a large coal component. But even in the US, the coal plant shutdown on thermal side might have to take a breather because of the power demand needs. So coal, I think, is, and I'm buying coal companies. Now, coal prices are at somewhat unusually low level. Gas prices have gone up, coal prices have not, but we think that'll just play catch up. Coal stocks I can buy on a normalized coal price if I use at 3.5 times EBITDA. Right. I mean, these companies are returning cash to shareholders hand over fist. So it's a great place to be.
It's interesting. And my cynical friends would say, look at that coal-powered Tesla go, and I've heard that for years. So I don't mean to be jaundiced or, about global warming. I know it is an issue, but it just seems like that what you just said is not very well known, I think, because you look across all energy and you look globally. I think it's clear what India, maybe we'll get into China in a minute, but what China's doing, they're using more coal than ever, but they're building nuclear. So we'll get to that in a minute. But I just want to go to oil. One of our past guests is now Treasury Secretary, and he talked about his 333 plan. And part of that is make 3 million BOE increase of oil and gas in the US. And certainly the Trump administration and their new energy secretary is very aggressive on traditional energy. But then again, that's not how the markets work. They don't drill more because the government tells you to. What are you seeing in oil?
The government may say drill, baby, drill, but investors are very clear: don't drill, baby, don't drill. If an oil company announces CapEx increase, the stock price goes down. If a oil company announces a greater cash return to shareholders, the stock price goes up. So there's no question that at the end of the day, in the capitalist system that we have, fortunately, in the US, the managements listen to shareholders, not to governments. What governments can do is incentivize more drilling. So what are they going to do? Give tax rates to drilling? We'll be happy to pocket that money as shareholders. It's still value destructive for the companies to drill and drive oil prices down, no matter how much President Trump may want lower oil prices. They're not going to destroy shareholder value. We'll be happy to take any tax incentives and pocket the benefits as shareholders. I think the interesting thing is you said 3 million BOE, and I think Scott Bessent is a very smart man, and he understands it need not just be oil. I think the real answer is going to come in increased drilling for natural gas as more LNG export capacity is built, as more data centers, faster power plants, faster data centers, faster AI support, faster crypto mining, right? Whatever, all of those things will require energy source, and the baseload energy source is clearly going to be natural gas. And so I think the need for incremental drilling for natural gas is absolutely there. If gas prices stay above $4 on a sustained basis, the shareholders would be supportive of gas companies drilling more as the demand visibility becomes much more clear. So on the oil side, I think the real issue, going back to your oil question and getting away from the US drill, baby drill, is President Trump also asked OPEC to increase production. Well, the reality is OPEC will increase production if the US tightens the screws on Iran. And if the Iran, which is, I think, exporting about 1.7567 million barrels, 1.7 million barrels more today than they were under President Trump, if even 1 million barrels or 900,000 of that comes off, that will give phenomenal opportunity for the Saudis that have had to cut production to make room for Iran and for Venezuela. Both of those are cases where we think the Trump administration, it's already showing it on Iran, and it may do it in Venezuela. If they tighten the screws, that's going to mean that that's going to give more room for the Saudis to increase oil production, which will provide a base for oil prices. Because one of the biggest concerns in oil markets has been that there's too much surplus capacity in OPEC. And if history is any lesson, that is somewhat dangerous. In 2014, the Saudis got tired of supporting the market and pulled the plug, saying, we're going to start producing like crazy, and the prices crashed, and they were trying to teach shale a lesson. Now they don't have to worry about shale because shale growth is gradually slowing down. So last year, I think it was about 400,000 barrels a day. This year, we'll probably 200,000 to 300,000 barrels a day. And, that is oil plus liquids, probably was 400 or 500 last year. It'll be 300 this year. So it's gradually tapering off. So I think that the oil market is not one where I'm table-poundingly bullish, but I would be much more positively inclined towards oil-related companies if Iran sanctions get tightened and so OPEC surplus capacity, particularly Saudi surplus capacity, comes back to the market. It balances the market, but it also takes the overhang of the tail risk away of prices crashing.
I think I learned from you, switching now a bit to nuclear, that an investor can actually buy physical uranium, which floored me 15 years ago. You explained this to me. And so you've been around nuclear for a long time. I mean, how do you think nuclear fits here? I mean, you touched on it. It's very long. I mean, the U.S. Energy Secretary just did an interview saying the number one reason the U.S. is not building more nuclear is because of regulations. It's making it so difficult. While China is cranking them out. They'll do 10 new nuclear power plants in 2025. What do you think? What do you see?
Well, I think there are 2 or 3 different ways to unpack it, but the most simple one to answer the question you're asking is that China has standardized a design for nuclear power plants. And in that standard design is where everybody's building. And so you get the learning curve and the efficiencies so that they can build a 1 gigawatt, 1,000 megawatt power plant for about $2 to $2.5 billion per plant. The US, the last ones that we built were about $14 billion. That is uneconomic,
right? No
matter how green we want to be. So one of the things that we did wrong in the US is in the last round of building, we built about 105, 110 plants with about 50 plus new technology into different technologies. What I think this administration gets, and actually the last administration started to get it. The NRC wrote a paper about this a few months ago, which is that they're going to have to standardize around a couple of technologies. The US will never be as efficient as China in terms of cost of construction, but if China can do it for 2.5, we can do it for 5, which is good enough for us in terms of our cost structure. But to do that, we have to get the technology standardized so that there isn't that. So that's the large nuclear power plant. It's an even bigger problem with what we call SMR, small modular reactors. And there, the government and energy secretary and the DOE will have to play an even bigger role. Because the problem with small modular reactors is today every hyperscaler has their own favorite technology. So Google chose somebody, Amazon has said they've chosen somebody, I'm not sure if Meta has come out with a preference, but there's all these different technologies floating around. The reality is that I think it was about a year back that we had NuScale Power announce a contract a year and a half ago for their first SMR, small modular reactor, where the cost of power was going to be about 8 to 10x what it costs in the utility today from any other source. That contract got canceled. And the problem is the first plant is going to cost 8 to 10x what the 10th plan will cost, 10th or 15th or 20th will cost. If it's Boeing, they can afford to absorb the cost where the first plane's costs are lost by the time the 15th plane or 20th plane rolls out, they start to break even and then they make money on the balance of their fleet. So they can amortize that losses of the first few by pricing everything flat. With the SMR companies, these are all tiny companies. The government is going to have to play the role, which is an unusual. We are not a country that does industrial policy, China does. But to make this, not only do we have to pick a few standards, but we have to underwrite some way the cost of the first 5 or 10 so that you can get the cost benefits of the later ones in a way that gets spread out. So there's these interesting challenges which nobody talks about when they talk about SMRs.
Well, we could do it, Arvind. I mean, whenever someone tells me about this amazing technology, SMRs, these small modular reactors, I remind them that we've been putting them in submarines for about 60 years, and they are small modular reactors, and the government standardized. So it's a great point. How about a little more downstream? What are you seeing in the utility space? That has just caught investors. I mean, I think Constellation, because they're nuclear assets, Talent Energy, that was probably one of the hottest trades last year. What are you seeing at the utility side of things?
Well, I'll be honest, we are not conventional utility investors, and that's part of, we've kind of defined our energy universe somewhat differently, or we've not differently, but we've stopped at the pipeline stage and then the power plants, but we have gotten interested in the power space. And so, we currently look at some of these companies, whether it's a Vistra or a Constellation or NRG, with some interest and looking for opportunistic, plays there. But we're also interested in some of the companies that are providing the opportunity to build out the power. So what we are looking at now, yes, the utilities, the IPPs have the pricing power because they have a scarce resource that the customers need today. But there's another angle to it, which is that if I want to, when Elon Musk built his XAI data center in Memphis in record time, in a month, what did he do? He got a power from the utility, but he went to a company in West Texas, which had been putting together power plants for frac fleets which were switching from diesel to gas, converted to electric fleets. And he went to them and he said, there's a gas pipeline near my thing in Memphis, which is close to, some gas flowing through. Can you build me a 200 megawatt power plant quickly? And this company helped them put that power plant together. They don't provide the equipment, they just package the whole thing and create a power plant for him. So we are looking at companies which are coming from the oil patch, which are providing this experience that they have of converting gas to power, locally distributed, mobile. And now suddenly people are looking for behind the meter, as it's called, solutions, which are quick and which can provide answers. So we're looking at it from that, kind of creating a mini power plant quickly. We're looking also at, obviously, a stock that we don't own that has done very well is GEV, which is a turbine maker. but other companies, Europeans, which are beneficiaries of this in terms of either turbines or the compressors that are used to put these quick power plants together. So I didn't go to the utilities because that's not our sweet spot, but the power side is our sweet spot. And we're looking at interesting ways to play the utilities. We missed it. We didn't invest in it. They had a great run last year. I'm sure there's juice left, but I think the real new opportunity that we're seeing coming up is with this power opportunity for people who are providing behind the meter solutions. And we actually own a coal company which has a coal-fired power plant, which is signing a deal, multi-year deal with a data center. And nobody's talking about this coal company, which actually has a coal-fired power plant. And that could be a very interesting, nobody's valuing it as anything like the IPPs. It trades at 3 times EBITDA. So there's interesting opportunities off the beaten path that we also look for.
I love doing this because I learn stuff, and I think the XAI's Memphis power plant. I hope we learn a lot more about it because that is just an example of innovation. It's the biggest supercomputer in the world. It's still
Yes.
not quite finished, and it's extraordinary. I love it. Yeah, I've heard that ExxonMobil, Chevron, they're doing stuff upstream, downstream for the first time in their carbon sequestration in one case. Exxon looking at the power markets. It's fascinating. Could you go through an idea? Do you mind? Because I just to get a sense of how you gain conviction and how you pull all these big things, these big thoughts together. And I know you're a bottom-up investor, so I just would love to hear an idea and then how you got to that idea and how you got conviction.
So I will talk about one of the ideas that we're looking at in the power space. It's this European company, and it's kind of uncertain how it'll play out. So it's a small idea. I don't want to talk about my big idea right now. I'll talk about a small emerging idea. There's this company, Wärtsilä listed in Finland, and it's a compressor company, and it provides compressors. It's an engine manufacturer which provides engines for about a third or 40% of the world's shipping fleet. So
I missed the name. I missed the name. What was it?
Wartsila, Wärtsilä.
Thank you.
And so they provide, if you go to a yacht, a high-end yacht, or you go to a cruise ship or a large oil tanker, about a third of maybe 40% of them will have Wärtsilä engines. But they also provide compressors which are used to generate power, and most of the demand from the power side has come from backup power for renewables. So if you've got a wind or solar and you need some backup power, then you use a Wärtsilä engine. But the emerging thing is when we talk to these companies that are providing these quick power from gas to energy, it's much more efficient. So there are 3 choices you have. You have a GV large turbine, which does combined cycle, big efficient power plant, which takes 3 years plus to build. You go for a simple turbine, which has a much less efficiency heat load than a Wärtsilä type of engine or Caterpillar or somebody's engine that converts. So if you're looking at a quick solution, these engines are more efficient than going through a simple turbine. So we see this demand has just started to emerge. It's people, they've just been talking about it. We think this is going to take off. This demand is not being discounted in the story. They've talked about it a little bit, but people are skeptical. And so we find this really interesting niche opportunity of this company, which is a market leader in one space and is a emerging player in another space, which is power related, which we are very excited about. And we think when you look at the energy efficiency of what a Wärtsilä engine offers, or there are other players, but this is the purest play we could find and one that is not valued because European companies are much cheaper when you find some of these opportunities. US investors are much more go-go about the whole data center plays. And so this is an interesting special situation that we are attracted to.
Very cool idea. Yeah, I've never heard of it. And I've seen that European discount with GEV and Siemens, right? Siemens Energy, which is a very similar business, but they're global.
And this is a $12-13 billion US market cap company, so it's not a tiny company, but it's virtually unknown to US investors.
Could you touch on mining just a bit because I know you do it, and it's copper, iron ore, the whole thing, and I just where you think there are good opportunities or you think there investors should fade?
So I have been bearish iron ore for the last few years, and it has generally been the right call. And so now it is about 50% of the world's seaborne iron ore or demand comes from China. China's steel demand has taken a huge hit. So China, what it has done is to keep its steel production going, has exported a lot of steel in the last couple of years. And it's been Southeast Asia, India, Europe have been favorite dumping grounds. US has been more restrictive, but with Trump's tariffs coming in, I think tariffs are going to become even more popular. And if India, which has built its own steel capacity, is getting Chinese steel dumped, and if they follow the US example and put tariffs, which they have done in the past, which I suspect they'll do again, that's going to further back out Chinese steel. So I think that if Chinese steel output declines, which it could if they have to kind of right size their steel industry to not be able to keep exporting their problem, then that would be a headwind for iron ore. And iron ore also structurally has a major new supply coming on in Africa and Guinea called Simandou. And this is a supply that coming on at a time when I'm not sure that the world is, at least China is not looking for more supply. So who else will have to absorb it? India is largely self-sufficient on iron ore. So maybe there's a play short term if there's a big rebuild of Ukraine. That's the bull case in the short term. But notwithstanding that bull case, we think iron ore is structurally less interesting to us. We've looked at steel, and steel is an area that's interesting to us. I think whether it's whether it's a European rebuild or more tariffs coming in, the domestic steel industries benefit. So whether it's an ArcelorMittal, which is both U.S. and Europe, or it could be some of the U.S. steel companies that could be beneficiaries from a more protected market. But when I look at copper and aluminum, the biggest headwind has been China. And we've largely stayed light in these places. We've traded around. But I think 25 might be the year where we'd get in more fully, because the Chinese market is now at a bottom. It has gone through, the housing starts in China have declined from 3-4 years ago by about 40, 45, 50%. So therefore, the housing market has collapsed to a magnitude that we haven't seen anywhere else in the world on a sustained basis. And we don't think it's coming back, but it's not going down anymore. On the other hand, the electrification, whether it is electric cars or electrification of homes. I mean, New York State, I'm not sure if you're aware of this, has this rule that after 2026, certainly New York City, I think it's a whole state, all buildings cannot have natural gas. They have to be all electric. So, this electrification, green is also in Europe, and all of that is going to mean, more demand for copper. Aluminum also will be needed. All the grid build out is going to need a lot of copper. We're going to need a lot more grid build out around the world, and that's going to require copper and aluminum. So I think that these two metals have had a 3-year headwind from China, which is finally coming to an end. And we think this could be a very interesting year to actually get a sustained move. Obviously, you have the Freeport Coppers and the Alcoas as the bigger winners, but we find some of the Canadian second tiers very interesting because they have better growth and there's a lot of M&A. If I'm a BHP or a Rio or a Freeport and I'm looking for growth, buying some of these Canadian companies which have significant growth projects in Latin America or in Africa could be an easily tuck-in acquisition. Obviously, BHP has been trying to buy Anglo and they'll be back again, but I think some of these second-tier companies could be very interesting on that respect.
I mean, it's throughout what you're saying in general has been policy related, macro related, bottom up. But I'm just wondering, like, how. I mean, I think active management in your space is so important because you don't know what's going to turn coming around the corner. I mean, we could have peace in Ukraine, we could have big issues with the U.S. debt, we could have war, a kinetic war, real break out in Southeast Asia, or so. I mean, I think that active management in your space seems to be critical, like being confident and then moving your feet. Is that your strategy, or do you take a much longer term structural view?
No, it is absolutely our strategy. We are always watching. I mean, for instance, when we own companies, we sometimes list. We can only say X% of our portfolio is listed in North America, Y% in Canada, Z% in rest of the world, which gives a false sense of security, because the real issue is, if I have Freeport Copper, I have to watch what's going on in Indonesia with the policy there. If I have one of the miners in Canada with assets in Argentina, how has the Malay government, how has that increased the value of the opportunity there, or what's going on in Chile or Peru? If there's protests by the local population in southern Peru, what's that going to mean for the mine output? So there's a lot of risk management you have to do in terms of understanding in our portfolio where the political risks lie. And like you said, the policy, every day there's a talk now with President Trump and his administration about peace in Ukraine, and trying to understand, A, what is the probability of that happening? B, how does that impact shipping? How does that impact oil? How does that impact gas? How does that impact, there's going to be impact on a lot of sectors that we look at, and how is it going to impact metals demand? I was just just before this, I had a meeting with a shipping company which said that 25% of the world's, I think it was ammonia trade used to come out of Ukraine. I had no idea. So the question is, how quickly can ammonia start exporting? And so he told me that it's been all bombed, so there's nothing there. But these are interesting aspects that we try to take advantage of.
Yeah, embarrassingly, I've got to remind myself what we use ammonia for, but it is fertilizer, right? So yeah, and so and also a way to transport hydrogen, right? So that's what's interesting. There's always a secondary use. Is real quick, maybe the last thing I wanted to go through is, I know you manage a very big book at SAC, and then your big launch Geosphere with a very large investment team, and now Geosphere 2.0. You have a relatively small investment team, still covering a pretty complicated world, and a global world plus all these different sectors, and you have to know everything. Which is better?
Well, I think small gives me more flexibility, and look, I would like to have. I don't want to say that I don't a larger team. It doesn't add benefits in terms of covering more of the waterfront and getting more deep in the weeds. But having been doing it for as long as I have, I think the benefit of that is that a lot of the stuff, we had a big bet on Tidewater, which was a big winner for us in 2023. I used to cover that company as a sell-side analyst in the late 80s. So, there's a lot of benefits to having been around for as long as I have in terms of being able to manage with a smaller team. But, I think we're in the process of trying to grow our capital base, and as we do, we'll add to the team. But our performance, as you mentioned earlier, knock on wood, has not been impacted by the size of our team. If anything, the opportunity set keeps growing, and we still find ways to hopefully make money.
Yeah, I mean, I do think having a long memory in your space is it's a great value, and it allows you to quickly adapt. Arvind, it's really great. I've really enjoyed talking with you, and I thank you very much.
Thank you for supporting the Thematic Investors podcast, presented in partnership with Vidrio Financial. Vidrio's data management solution collects, scrubs, and allows investment teams to filter out the data noise, providing you with actionable data intelligence for further visualization around valuation, risk, and portfolio management. If you are an endowment, foundation, pension, sovereign wealth fund, asset manager, OCIO, or family office struggling with your data pipelines, then reach out today and see how Vidrio's data management solution can help by becoming an extension of your investment team. The information covered and posted represents the views and opinions of the guests and does not necessarily represent the views or opinions of Vidrio Financial and/or our host, Kieran Cavanna. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding investment planning.